It's 4 p.m. here at DBS Asia Central. I'm Temur Beg, Chief Economist at DBS Group Research. I'm here with Senior Economist Radhika Rao. Hi, Radhika.
Hi, Temur. Good to be here.
It's been a while since we did a live stream together. Look forward to going over our material together for you over the next hour or so. The title of today's presentation, Risk Divergence. And the reason we talk about divergence is because what we considered risky 2 months ago seems to be less risky now, and what we didn't really consider very risky 2 months ago have become riskier. So that's the divergence, and what it means for markets, pricing, and strategy is the key goal of today's presentation. At least in the first half, I will sort of laser focus on that area. When Radhika's turn comes, Radhika, you have some other macro stylistic stuff to discuss with respect to India and Indonesia as well.
Absolutely.
Very good, Radhika. So I'll see you a little later.
Sure.
Okay. So in terms of things to do, I have a QR code on the screen right now. It's for Pigeonhole. Please scan this, the QR code, or go to dbs.pigeonhole.at, type the passcode macro, M-A-C-R-O, and you can also send us questions. We'll keep an eye on them, and we will spend the last 10 minutes of this presentation going over the questions, as we always do in this live stream. All right, so Radhika, as I said earlier, will be talking about India and Indonesia in her half. I will spend the next 20 minutes or so talking about the evolving risk dynamic. And under that, I have about 4 different issues that I want to touch upon. One is the consumer outlook of the US. Second is the policy expectations dynamic, which has become a bit muddled lately. Then what's happening with Asian trade, and then China. And in all of these areas, again, as I said earlier, that the risk proposition has sort of changed over the last 6 to 8 weeks. We came into the end of summer thinking US consumers were about to fall off a cliff. They had consumed a lot, high rates were beginning to hurt, labor market was probably going to weaken, and consumption would soften. That narrative has sort of turned on its head recently, so we're gonna take stock of how strong the US consumer outlook is as opposed to the previous perception. And then around the strength in US consumption, strength in job numbers, and some mild stickiness in inflation, the policy expectation of how far the Fed can cut rates has also gotten rather conflicted, and we'll touch on that. Asia, over the last year, we have sort of talked about how the trade cycle is helping. We might be seeing signs of that help beginning to fade, and I will touch upon that. And then there's China. Very exciting these days. A lot of exuberance in the financial markets, a lot of expectations about strong policy action. Our point would be that we are sort of happy that some of this excitement has materialized, but at the same time, there's still a lot of question marks on China, so that we will touch upon as well. All right, so let's go into the US consumer outlook part of the discussion. Now, sitting here in Singapore, making a presentation from DBS Bank, why do we spend so much time talking about the US? Well, it's because we represent a region that is very big on exports. Singapore, for example, has a trade GDP ratio of over 400%. US is, without any question, the largest procurer of all the exports coming from Asia. US consumers account for just about 4% of the global population, but 30% of the world's spending on consumption goods and services. And hence, where the US consumers go, that's where the Asian exporters go. And hence, we use quite a bit of our analytical prowess and thoughts on looking at the US consumption outlook. Now, starting with the labor market discussion, US consumers are feeling pretty good about themselves. Jobs are aplenty, contrary to some of the jobless claims that we had seen earlier, or some of the payrolls numbers that we had seen in the summer, when the view was that there's a softening, gradual softening of the US labor market. The latest data prints again have shown wages holding up pretty well, and unemployment rate just at 4.1%. This is not, in any stretch of imagination, reflecting stress or slack in the labor market. Labor market remains as tight as ever. You could argue the vacancy numbers are not as ample. Big tech companies, having gone through a big hiring spree, are not hiring as much. All of that is true. But there is a large public sector dynamic in the US with respect to job creation, And with the Inflation Reduction Act and the CHIPS Act, a lot of money is going into infrastructure spending. Jobs in those areas are booming. Construction is still doing pretty well. The services industry is doing extremely well. So I don't think somebody with some degree of relevant qualification in the US is struggling to find a job even now. And then that, again, makes the US consumption outlook look pretty good. The key reason why this rate hike cycle of the last 2.5 years has not been hurtful to the US consumer is because they have started from a position of strength. If you look at household debt to GDP, back in the time of the global financial crisis, it was about 85%. At that time, even when rates were zero, the consumers in the US were burdened with so much debt that their ability to consume any further was severely hampered. Today, the story is the opposite. Interest rates are high, but since consumer debt is so low, now you couple it with the observation about the labor market, the jobs are aplenty, wage growth is pretty decent, well ahead of inflation, then of course, high rates don't hurt that much. There's also this peculiar aspect about the US mortgage market. Americans tend to have 30-year fixed mortgages, 15-year fixed mortgages, very different from most of the householders who own mortgages in the world outside of the US. So that also reduces the duration risk substantially for US consumers. Most people have longer-term mortgages than anything that required a reset in the last few years. So for them, rates going to 5.5% of the short end didn't really matter. So A, stock of debt is low, B, duration risk is low, and C, income, jobs prospect, everything is pretty good. Now, I mentioned wages earlier. The earlier chart was about nominal wages. This chart is about real wages, and it's not looking at the year-on-year growth rate. So this is not corresponding to that 4% nominal growth chart that I was showing earlier. This is about the level of real wages in the US, indexed it to 100. And as you can see, that the big inflation spurt of 2021, 2022 had a big impact in pushing down wages. Consumer purchasing capacity was eroded rather severely during those 2 years because of the unexpected sharp spike in inflation. Since then, wage growth in nominal terms have been decent, just as when inflation rates have started coming down. So wage growth has turned positive in real terms, both in 2023 and will almost certainly be positive in real terms in 2024. So we've begun to regain the lost ground from the pandemic years, and things are sort of going in the right direction as far as purchasing capacity of American households and consumers are concerned. You see that reflected in the retail sales number. It has gone through quite a bit of volatility, grew very strongly in 2023, slowed down sharply at the beginning of this year, but since then, again, has picked up pretty well. So we estimate, and the way we estimate it is we take the monthly retail sales numbers, seasonally adjusted, and then annualize it to get a sense of what is the run rate of retail sales right now. And we see retail sales growing at about 5%. This is going to be, again, a good set of numbers going into the final stretch of 2024. A little more about consumption, our consumer outlook. Inflation has come down, which shows up in the gray line and the red line over there, CPI and core CPI. And the monetary side is beginning to look again decent. We saw a pretty severe contraction in money supply through the course of 2020 to 2023. At one point, after growing very strongly, it was contracting by about 5%. Since then, it's sort of normalized. So liquidity, money perspective, also things are looking pretty constructive for US households. I mentioned this earlier about mortgage rates, 30-year and 15-year fixed mortgage rates peaked close to 7.5%, 8% earlier this year. Has come down quite a bit since then. Mortgage rates are not as low as they were in recent years, but when you go all the way back to the global financial crisis years, 2008, 2009, we're basically back to those levels. And mind you, we had a pretty decent run in property dynamic before the GFC. So it's not about the rates itself, but it's about income. It's about people's consumer outlook. When those things are good, high rates don't deter people from buying, whereas when things are not good, even very low rates don't bring people back to the market. Okay, so much so about US consumers, but the good consumer outlook has implications for policy. The Fed went ahead in September, cut rates by 50 basis points, and the market got very excited after the Fed meetings. The last couple of weeks, the market has gone all over itself because first, in the immediate aftermath of the Fed rate cut in middle September, third week of September, the view was another 50 basis points cut in November is all but guaranteed. And there might be even substantial more rate cuts after that. All of that exuberance has sort of softened a bit with data looking pretty strong since then. And the Fed is also not giving any signals about its desire to go for another jumbo rate cut in November. There's absolutely no rationale for that. We personally, as you know, did not think there was much rationale for a 50 basis points rate cut even in September. We were wrong there. The Fed went ahead and cut 50 anyway. In hindsight, it doesn't actually look like that great an idea. But they did it. We have to live with it. But the upshot is that we have to adjust our rate cut expectations going forward, having already had an exuberant rate cut, maybe not a lot more exuberance left in this cycle. So this is our forecast. We took that 50 basis points rate cut in our stride, extended our expectations of another 50 basis points, 25 in November and December for the remainder of 2024. So we will end this year at 4.5%. Then we think the Fed is in a position to cut steadily in every single policy meeting going into the third quarter of 2025, which will then take the Fed funds rate down to 3%, meaning between the end of 2024 and the third quarter of 2025, another 150 basis points of rate cuts, and the terminal rate then in the cycle becomes 3%. Maybe not likely. Right now, that is our forecast, that is our baseline. When you see our annual outlook, you're gonna see no different forecasts in November, but it is conceivable that the risk around this scenario is to the upside, meaning a 3% terminal rate might be too low given the strength in the US economy. If the economy has no landing whatsoever, maybe the terminal rate would be closer to 3.5, if not higher. It really depends on the inflation dynamic and demand strength, but no landing scenario will probably make the Fed's life more complicated. And these sort of guidance, which is based on market pricing, our own expectations, and Fed communications, may turn out to be, again, too dovish. Maybe it won't go that low. As I said earlier, that the markets have turned rather volatile around these developments between the end of the Fed meetings in September till now. Over the last 3-4 weeks, we have started scaling back expectations of major rate cuts in the remainder of the year. And by remainder of the year, we're basically talking about 10 weeks left in the year, 2 more Fed meetings. The market now is back to what we have been calling for, which is 25 in rate cuts, which will take the cumulative rate cuts for 2024 to 100 basis points. Now, the area where the market has turned more hawkish than us is the 2025 expectation, because now the market view is that for 2025, the Fed barely has room for another 4 cuts or 100 basis points. So the market is now looking at the rates sort of stabilizing around 3.5% next year. So from us being very hawkish to now the market turning more hawkish relative to us, there's a 50 basis points gap between where we think things could go in 2025 versus where the market is. So the market was, as you can see, pricing in 150 basis points of rate cut in 2025 and perhaps 125 in 2024. So altogether, 275 in rate cuts in this cycle. Things have changed so dramatically since then that now barely 200 basis points of rate cut is being priced in. So the market has gone from forecasting more rate cuts than us to less rate cuts than us. We will not chase the market. We will stay with our call. We do think that there will be room to cut, provided inflation maintains a steady disinflationary path. Let's see whether we get it right or the markets do. The muddled policy expectations are also seen in the sort of shallowness of the US yield curve. So when we look at the yield curve as of the beginning of September versus now, things have changed a lot. Of course, the market has adjusted for the fact that rates have come down, and hence the short end of the yield curve, which is the black line, has come down. And it's basically saying that we're going to be heading down to 4.5 before in the very, very near term. But at the longer end of the spectrum, it's shifted up. So the yield curve has sort of twisted itself around. The kink is around the 2-year mark. Around that point, anything before that, the rates are lower than they were about a month and a half ago, whereas beyond that point to the right, it is higher than where it was about a month and a half ago. And you see these sort of contortion of the yield curve also getting picked up in the FX market. Just a couple of months ago, I'm pretty sure in the last 2 live streams, we have talked about our bearish view on the US dollar and how around US Fed rate cuts, it'll be a big source of breathing for emerging markets because the currencies will get supported with the dollar selling off. The market's positioning is still in that direction. So the net positioning is definitely on the shorter side. People are shorting the US dollar, but the actual performance has turned upside down. Again, in line with the risk divergence narrative. So we've seen actually the dollar rally as opposed to selling off in the last couple of weeks, which again has led to rather unexpected outcome with respect to FX returns. Again, emerging markets is performing poorly relative to developed markets and some degree of risk aversion around what's happening in the Middle East, some degree of concerns about what's happening with the US election. All of that is feeding into the risk aversion dynamic, which in a perverse manner actually helps the US dollar, not weakens it. We're also seeing what's happening with financial conditions, and this is an example of how the Fed's hand might get tied going forward. The mild bit of rate cut has already been accompanied over the course of recent few months with significant easing of financial conditions. We haven't had such easy financial conditions in a long, long time. You have to go back to like the immediate aftermath of the pandemic when the system was being flooded with liquidity to find a common point. And this is true not just for the Fed, but also for Eurozone. So you may have issues related to the amount of rate cuts that's conceivable, possible in the cycle, but at the same time, why do you need to cut rates if financial markets conditions have already eased substantially on the back of ample liquidity and strong run-up in stock prices? So how do you put it all together? Well, in one area is the inflation-adjusted securities market, the TIPS market, which allows us to extract inflation expectation for the near term, and based on that, we can start creating real interest rates, centered around market-based observations and indicators of inflation expectation. What do we see there? Well, the 10-year break-even has picked up just a tad bit lately. I think, again, it's a function of demand is strong. Why should inflation come down? We should expect closer to 2.5% inflation as opposed to 2% inflation. But then that feeds into the fact that real rates have just come down a little bit now, except the very, very recent weeks, it's gone up a tad, but it's on the back of, again, inflation being slightly stickier than expected and nominal interest rates beginning to come down a tad. All right, so how does sort of Asia fit into this narrative around risk divergence, strength in US consumption, as well as what's happening to the policy environment and the muddling expectations there? Well, somehow US trade right now, Asian trade, is not necessarily reflecting the strength in US consumption. So the first chart that I have for you in regards to this is ASEAN 6 exports. We have the data all the way through August. We have a few countries' September data already, but not necessarily ASEAN 6, more in North Asia. And then we have the PMI number. PMI had mounted a pretty handsome recovery from the trough of late 2023 and climbing all the way to 52, 53 mark, 51 and a half marker by the middle of this summer. But since then, it's begun to weaken, which is sort of beginning to worry me a bit, because my view was that 2024 was going to be characterized by steady pickup in exports and consumer demand being fairly strong. But instead, what we're seeing is that PMI has begun to turn. You're not seeing that in Asian exports numbers yet. Exports on a year-on-year basis are still growing, but I wouldn't count on it because historically, weakening of PMI is a harbinger for weaker exports data down the road. What if we expand the lens and cover all of EM Asia, not just ASEAN 6? We get a slightly better number in the sense that PMI on average is on the well above 51 marker, so better reading than what ASEAN 6 are showing. And on the export side also, still close to high single-digit, low double-digit numbers for most of these countries in North Asia, which then pushes up the entire average. So countries like Korea, Taiwan, Japan still are seeing fairly decent amount of demand for the kind of products they produce. Vietnam would be also added to that list in my view. But for the rest, on the commodity side, on the lower end electronics side, things don't look that rosy. Mind you, Singapore is, of course, focusing on high value-added exports, and they are also Singaporean exports are facing pretty decent demand, and that's been feeding into steady upward revision of GDP. But for the rest, Thailand, Indonesia, Philippines, and so on, life can be a bit challenging going forward. Finally, on China, it's been a pretty frenzied few weeks. We saw very forceful market-defending words from the Chinese authorities a few weeks ago, followed up by a series of stimulus-related announcements over the weekend. But our view on China is that the stimulus measures need more detail. We can provide you with tables like this, spanning many, many pages, talking about central government finance, how much money is going to be given to local governments to deal with property sector issues, how they're going to be relaxing taxes on R&D, support consumption, help financial sector, improve social welfare, and so on. All sounds pretty good, but I think the market is keen to get more numbers, the quantum of support that will be available for the economy so that we can then feed that into our GDP models and get a better sense of where GDP will be in 2025. That sort of information is still, unfortunately, unavailable, and the market keeps on sort of waiting for that. So again, you see that impatience of the market reflecting on the measure of CNY stress chart. Through a large part of this summer, the RMB was under a lot of pressure. That sort of turned upside down with the Fed rate cut, and then we saw significant buying pressure on the RMB, something that we haven't seen in a very long time. But then again, in the last week or so, that narrative has gotten challenged because the US dollar's rally, again, feeds into that expectation that rates may not come back that much. Finally, China also needs more details on credit creation. The banks, need to find ways of generating more deposit, whether it is through quantitative easing or releasing of reserves by the central bank. It just needs to be done. Because once that happens, the banks can then start lending them out to the rest of the economy. What you're seeing in this chart is in total social financing and net bank loans, both are growing at a pretty anemic number. There's room for improvement, some degree of clarity on the policy environment, some degree of clarity on seizing regulatory overreach, I think would be very helpful for Chinese consumers and financial market participants. And we probably will need something like that before we have proper improvement in social financing. All right, final words, not entirely related to everything that I've talked about, but this thread will also be picked up by Radhika later on in the context of Asia, and that is thoughts on commodities. Now, we've had a tense month. There's been an expansion of hostilities in the Middle East, and that has caused a lot of questions about what's going to happen to oil, especially if indeed there's a wider war between Iran and Saudi Arabia, Iran and Israel. We could see oil infrastructure getting affected. But as you can see in this chart from the red line, oil on a year-on-year basis is still down. It's not up. In real terms, oil is like 60% below its all-time high. And even in 2008, 2009, we saw much higher both real and nominal energy prices. So we think that there's some upside to energy if indeed Middle Eastern conflicts were to worsen. But at the same time, we think that there's tremendous capacity in the world to absorb the demand. There is production capacity idle in the US, in the Middle East. OPEC plus countries have substantial excess capacity. And on the demand side, between green transition and China slowdown, it's not that great either. Hence, we find it hard to get too excited about crude oil in the near term, even if there is some additional tension on the geopolitical side. And the rest of the commodity, other than gold, life is pretty stagnant or mildly bullish. So when you look at wheat, soybean, copper, all very important markers of global food and energy and metals demand, and those things are still in the doldrums. Of course, gold is a different story. A lot of questions about wanting to hedge gold, hold gold, trade gold, And as a result, we've seen gold prices up 50% on a year-on-year basis. But when we think about inflation, it doesn't make a very large part of the required list, and therefore, not a massive source of concern. So that's where we are, which is consumers in the US are looking good. That should help Asian exports. And even if it doesn't to a large extent, it certainly should create a floor. But it is getting in the way of market expectations of very large amount of rate cuts. We think that as long as China's demand remain on the weaker end of the spectrum, we should not worry too much about commodity price spike or commodity price related inflation problem the way we saw in 2022. The world is a very different place now, and the market sensitivity and ability to absorb those shocks is far, far greater. With that in mind, Radhika, let me pass the baton to you. Don't forget to tell us about the QR code for the Q&A session. I'll see you later. Thanks.
Hi, everyone. So I think what we have in store for you is a QR code. Please do use this or go to the website as mentioned on the right and enter the passcode, and you'll be able to get into our Q&A section. We do welcome any questions in the economic of markets realm, be it the G3 countries or Asia at large. So taking over from where Taimur left off, especially on the commodity space, and I think what matters a lot more to the ASEAN region, India, and some of the Asian region at large is what happens to oil. And I think that's where we thought we will give you a bit of a regional perspective. We've showcased here the net oil imports of various countries in the region as a percentage of GDP. And this higher the number essentially shows that higher the impact on the trade balance. And we've taken a net figure here to again give you a sense of the dependency. For most of the countries here, we have tried to show you the crude part of the trade balance, trade numbers. Some of them which don't have very granular data, we have taken the petroleum products at large. So what is this telling us? This is essentially telling us that many countries in this part of the region are certainly net oil importers. Barring Indonesia, I would think to some extent, which produces oil, most of the others tend to consume. And especially when you see Thailand, for instance, if you see its own exports versus imports of oil, certainly is much more dependent, and thus any spike or any unexpected move in the oil prices tends to impact its trade balance. And of course, weakness in trade balance then percolates down to the other external balances as well. India has always been in the news, especially when it comes to it imports 80-85% of its energy requirements. And there too, again, if you see a buoyancy in oil prices, it tends to impact the trade balance as well. And what you see overall is that, especially if you go to the, what our oil analyst has been saying for the past few weeks, though despite, the escalation in tensions between some of the Middle East players, some of them which are very oil rich, you haven't really seen the usual reaction in the commodity market, especially in oil. And in light of that, in light of the demand supply cushion, our oil analysts have in fact lowered their 2024 forecast closer to about 80 or 78 as its median price. So they do think that markets at this point will probably react to any physical or rather any disruption to physical supply of the commodity rather than just concerns over a potential supply. And we do know that OPEC has actually undertaken a cut, and it does look like they might roll back some of that supply cut towards the tail end of the year. And that happens, then again, there is that much more supply in the market. And with economies expected to grow, especially countries like China, expected to grow anywhere between 4 to 5%, and India around 6-7%, will be the demand supply equation will very much be well buffered, well cushioned. So this is a sense we wanted to give you on the dependency. Let me now go into India proper. I'll follow that with Indonesia. And since we're talking about oil, and I think one of the big developments in the last 4-5 years has been diversification in the sources of oil suppliers, right? So India has been buying oil from, say, the Gulf countries for a very long time, the Middle Eastern partners for a very long time. And in the recent past, you've in fact seen some of that supply being reoriented to Russia, to mean that India has been buying a lot more oil from Russia. We wanted to give you a sense of, again, how much that quantum has moved by. And as you can see, the legacy suppliers still very much are important. We talk about Iraq, Saudi Arabia, or the UAE, but Russia has taken considerable market share. And I think it began with sizable discounts to the oil price, so gives certainly an advantage on the price front. But over time, we have seen that discount actually narrow. And nonetheless, the purchases still remain sizable, and that also reflected in the market share, or rather not the market share, but the share of Russia in overall oil imports purchased by India. And that's why you can see that there's been a bit of a diversification. There's a mix of a change in where oil is being bought from. So this helped to contain the kind of deterioration one would have expected. When oil prices spike, like I mentioned earlier, India's imports, oil imports particularly, tend to jump as well. There is, if we were to talk about the one-on-one impact, in fact, every 10 barrel per barrel price increase in oil tends to widen the current account deficit by about 0.3% of GDP as a rough calculation. So certainly every increase that you've seen, that will percolate down to the trade balances as well. So if there are any savings by way of diversification in the import suppliers, that can bring in or prevent a deterioration in the trade imbalances. So while imports, there's been a mix there, I also want to take the time to talk about India's exports. Again, the much is usually spoken about how India's consumption is doing, investment growth is doing. But when we are talking about the trade front, I think there is some interesting developments, especially if you see the composition of exports have been undergoing a change in India's case, right? So I've tried to split this a few ways. If you see the starkest increase in terms of nominal value has been in manufacturing exports. So manufacturing exports have taken here, things like chemicals, electronics, still a small part, but a fast-growing part of the export basket. You also see drugs and pharma, for example, which has contributed to the lift, besides project goods, for example, in the lift in manufacturing exports. Another segment that has done quite well is petroleum. Now, petroleum, while crude is being bought, India has also managed to step up its refined petroleum exports to many parts of the world, including the West. And that has certainly brought in very crucial export dollars to the economy. Of course, when the price moves adversely, there tends to be an impact on that part of nominal exports as well. But there was a considerable 2.5 years when these exports are doing very well. And in fact, it continues to do well, especially on nominal terms. And then you've got, of course, some of the primary and other labor-intensive industries. If you talk about industries like, for example, gems and jewelry or furniture, textiles, those are still lagging the overall improvement in exports. And we do think that as the value-added part of the sectors continue to do well, and more and more policies are put in for the labor-intensive industries as well, you would tend to see an overall shift up in exports on a whole. So certainly composition-wise, goods exports have done very well. While I talk of goods exports, let me also take the conversation forward to service trade. Now, services is, again, another part of trade that has done exceptionally well, again, in the past 4 or 5 years. And typically, you would associate India's service exports with IT exports, software exports. While that is doing quite well, I think there's another crop that has really grown very fast. Rather than just being called the back office of the world, you have seen a lot more functions, value-added functions, move to India. That would be HR, R&D, some of the audit functions, some of the finance functions. And this has all come through a phenomena called the global capability centers. These are multinational companies or local companies that have set up office in India and have brought in a lot of value-added services to be done onshore. And that has certainly contributed to changing the color and the complexion of India's service exports. Now, why is this, again, important? For a long time, India's goods exports, or goods trade balance, or trade deficit has been quite wide. When you see a lot of strength in services trade, that helps to offset the goods trade deficit in quite a significant way. And that's why overall, if you see the current account deficit for the country has been quite manageable, a bit, at very manageable levels, at less than 2% of GDP. And that is on the current account, and on the same time, if you take the financing side as well, you've seen sufficient portfolio flows. I don't touch upon this in figures, but portfolio flows into the debt market, into the equity markets have been quite strong as well. So a narrow current account deficit, a good financing buffer, overall balance of payments has been in black. So this is just to give you an idea on how the complexion of exports has changed. Let me also take you to the growth momentum at large. Obviously, about 2/3 of the economy is still run by domestic demand, by consumption as well as investments. And here too, we see certain pockets that have done very well. We do know that the government has initiated a very strong capital investment cycle, and especially focused on infrastructure. And if you see the lending books of the banks and the financial institutions, certainly you've seen very strong growth in those particular buckets compared to fiscal 14 to fiscal 21. And this is the average we wanted to bring out. And you can see that roads and bridges in particular has taken a much bigger share in the loan book, and followed by metals and construction and other sectors as well. Again, this is the share. It doesn't show the year-on-year increase. If I were to show this data differently, you will see that some of sectors, especially like real estate, construction, has also picked up quite notably. And what additionally I wanted to bring in here is that the investment piece is led by the government, is led by the central government primarily. But that's not the only engine of investment growth at this point. You've also seen households participate very actively via their real estate investments, and that has also helped to lift the overall investment cycle in the country. Private sector corporates have also participated. We should remember that their books are much cleaner than they were, say, a decade back. So they are able to participate in sectors where they see a lot more demand coming in, and in selected sectors you've actually seen a lot more capex commitments by the private sector as well. We do think that when the domestic demand as well as global demand looks much rosier, that overall capex will also pick up from the private sector corporates, that is. So from the investment piece, moving on to the demand, and of course demand is by rural as well as urban households in India's case. And for rural households who are particularly dependent on farm output, good monsoon is always very good news, right? So we are just coming out of a crucial part of the year where you see southwest monsoons, and this time it's ended in a surplus. Typically you have a good surplus, you would find better returns for rural households, rural farm households, and that will indeed translate into higher demand as well. In fact, if you see some high frequency numbers, you can see that rural demand is in fact faring better than urban demand. And on that note, I also want to just bring in this consolidated gauge. And now if you look at 7, 8 unrelated indicators, it's very hard to give a common idea on how demand at large is doing. So what we have done is we have a consolidated proxy split between urban and rural demand. And again, to give you a sense of how are these particular demand engines doing. And what this is telling you is just what we derive from the second chart, which is that rural demand in the last 2-3 quarters is faring better, while you see a bit of a tepid a recovery in the urban part of the economy. But we are heading into a festive period in the country. In fact, it's already underway. It kind of peaks in the final quarter of the year. And typically at this time, especially for sectors like auto, you tend to see a seasonal pickup. And we do think that some of these lines will tick a bit higher when we have the next update in place. So overall, in terms of the growth momentum, investment, we are quite positive on. It's continuing to maintain pace, especially not only by the government, but also households. Secondly, on the demand front as well, we do think, while there's a bit of give and take between the rural and urban demand, we do think that consumption overall can hold at about 4 to 5%. And we should remember that as and when inflation eases, and I'll come to that in the next slide, falling or looser financial conditions will also be an additional plus for demand on a whole. And then trade, we just discussed in the slide before. Overall trade imbalances have narrowed. And again, that is a slower drag on overall growth. So where does that leave us? That leaves us with about a 7% growth, according to us, for fiscal 25. And going forward, we do think that if you were to take another 5-year view, growth would stabilize somewhere between 6.3 and 6.5%. My final bit on India would be on the central bank, very relevant because as Seymour mentioned on the Fed and Fed's move, especially when they went for an aggressive 50 basis point cut, attention quickly shifts to emerging markets and Asia on a whole, and what is going to be their reaction to rate cuts or their rate outlook. And here we saw that the RBI, which met last week, in fact, did not move on its rate, but it changed its stance. So it's changed its stance to neutral. It used to be withdrawal of accommodation, so hawkish to a more neutral stance. And I think the introduction of that stance change was with caveats, to say that yes, we are changing, but that does not mean the next move typically has to be a cut. They may continue to hold, they could be data dependent, so on and so forth. So it does give them, we do think that the stance change, in fact, was a move to introduce flexibility of what they want to do next. And we want to just give you a bit of historical reference on, how, with the overlay of the rate changes, how the stance changed over the last about 7-8 years. And you do see that whenever they are in neutral, they do hike or they do cut, depending on where they are in the cycle. At this point, of course, shift to neutral, we think, will be followed by a rate cut. But they will be looking at many things. And I think in this context, the latest data print that came out of India, which was the inflation numbers for September, showed you that there was a sharp spike in the headline inflation. And this is set against a backdrop of ASEAN countries, for example, where inflation has been steadily falling. In India's case, from August, 3.7%, September inflation has been at 5.5%, so quite a jump. A firmer number was expected because of base effects, but we did see food inflation also come back to muddy the waters for the disinflationary path. So we saw a sharper inflation number, stronger inflation number. Going into October, we do think it'll climb even further, perhaps in the 5.6, 5.8% mark before it peaks and slows down. So we need to see how the central bank will, interpret these numbers. Will they think that, take a forward-looking view 12 months hence, and go ahead and cut rates in December, which is our base call. But we will wait to see one more, growth print, which will be out in November, which is basically the GDP numbers for the second quarter of the fiscal year. That will again give you a sense of, is growth impulse weak enough for the central bank again to go ahead and cut rates. So for now, we are maintaining our December rate call, but subject to the upcoming data points, it could be December, or the probability for December will fall and for February will rise. Let me then stop with India and go on to Indonesia. And similar to the commodity start that we spoke about in India, for Indonesia, the non-oil and gas space is very important. And as you can see in the chart here, in fact, the gray area on the top captures the oil and gas, ex-oil and gas. So basically, these are other commodities apart from oil and gas. And you can see that the trade balance has been positive since 2020, for that matter. Peak somewhere in 2022, but thereafter we did expect a sharper correction in the trade balance, but that's not come to pass. In fact, today's trade number again saw very strong trade surplus, which means that even if some of the commodity prices have come down, in terms of commodity volumes, Indonesia continues to benefit. And recently, palm oil, coal has also seen some buoyancy, and that's passing through to the Indonesian trade balance as well. So certainly, outside of oil, what's happening is a big positive for Indonesia, not only on the trade balance front, but if you see what's happening to downstreaming as well. The government has made a very clear push to move away from waxing and waning just based on raw commodities. There's been a very concerted effort to downstream, and that you can see in the exports proportion of value-added base metal processing exports has risen and has risen very sharply again in the past few years. So this is a policy that has been in the making for 7-8 years now, and we think under the new government that's taking over in a week's time, this will even become a big part of the overall policy push. And on to the final part on the trade balance is FDI. So FDI has also, just keeping the same strain on the downstreaming and the commodity cycle is what's happening on the FDI front. And you can see in FDI as well, there is considerable increase in that base metal processing piece for the country, with, of course, other activities like logistics and transportation and so on. Going from the trade piece to what the central bank is likely to do. Now, before I shift gear, just to give you also a sense of overall growth in Indonesia's case, we do think that Indonesia is heading towards about a 5% growth this year. And that is going to come from outperformance on the trade front, as well as slower but positive growth on the domestic demand indicators as well. Just like the RBI, BI is also, of course, faced with a Fed that is likely to cut further. But for the BI, in fact, they went a step ahead. They did not move. They did not wait for the Fed to go ahead and cut. In fact, a day before FOMC meeting, BI went ahead and cut rates by 25 basis points. Now that reflects confidence on their inflation outlook. It reflects confidence on the financial conditions back home. And you can see the chart on the extreme left that inflation has been steadily coming down. And I think they took advantage of that window. Real rates cushion is also quite significant. In fact, it is usually about 200, 250 basis points. Now it's closer to 400. So the considerable cushion for the BI to go ahead and cut rates. The fly in the ointment is the currency. And this is where much of the official focus is, which might slow them or make them go faster on the rate cuts front. Rupiah faced quite a whipsaw. It appreciated a lot, and it's also weakened a bit, very near in the past 15 days or so. So we do think that in the very near term, BI might choose to be a bit cautious, but thereafter continue to ease rates to about 5% by end of next year. And the final piece on Indonesia is about the new government. New government takes office within a week. A lot of questions facing them. They take over an economy which has the ambitions to grow much faster than the 5% it's been seeing for many, many years now. So the government seems to be pro-growth, pro-investment. It'll be important to see how much of what they plan to do does translate into higher growth. Cabinet announcements always a very, very big piece. Of late, there are signs that the incoming government might retain some of the outgoing government cabinet ministers for important roles, including the finance minister. So again, that is a big plus if that comes to pass. We're just a few days away, and that will give us a sense of who is making it to the actual cabinet. Of course, in terms of their social fiscal push, they have been much more focused on improving human capital, stepping up social welfare, stepping up spending on a whole to try and support the economy. And finally, of course, what their relationship is going to be with other countries becomes quite important. And that's where we think that the incumbent defense minister, who's going to be the president-elect, has already very good relations with the outside world. I think with this, I'll conclude my piece and get Temur back to take on some of the Q&A questions. Thank you.
Thank you, Radhika. And the first question is for you. Let me put that on the screen. What do you make of the divergence in ASEAN 6 policy outlook? This could be for 1 hour, but I'm going to give you about 2 minutes to go with this. Yes.
Yeah, certainly. I think what you, again, since the Fed has acted, there's again a lot of attention on which countries will do what, especially in the ASEAN space. Philippines and Indonesia were two banks which actually, central banks that moved ahead of the Fed moved, right? So that shows that they were pretty satisfied about how the currency was doing. Inflation is easing at home, so they took advantage of that window as well. On the other hand, you saw Singapore, for instance, just this week, opting to not change their policy settings. And I think our analysts, Singapore analysts' view is that they would wait for keep staying near and the upper hand of the band so that it can bring core inflation down towards the target. And that's why they want to wait and see. So there is a considerable divergence. I would think that Philippines and Indonesia, again, would be the ones who would do a lot more cuts. Among them, Philippines would be, we think, most dovish. We should remember that they took rates to the highest amongst ASEAN 6 countries, so certainly they want to bring it down equally fast. So this would be interesting. I think Fed is important, but what is happening to their own currency, their own inflation, own growth, is playing a very important part as well. So they are going and taking advantage of the real rate buffer that they have to go ahead and cut rates.
But it's going to get complicated, going back to that muddle policy outlook issue, that if you believe that sustained dollar weakness is around the corner with the Fed rate cut narrative, then yeah, in Asia, you can go ahead and cut rates, not worry about the currency depreciation, and hope that the relative rate differential remains more or less flat. But now in the last few weeks, it's getting complicated. Now from Sing dollar has gone from 128 to 131 just in the last 2 weeks. Overall, DXY, as I showed in that chart, has picked up again. So do you think that the Asian policymakers will find the going a bit complicated?
Yeah, I think it's quite clear when you hear them speak is that they are not on a predetermined course at all, right? They know they're in an easing cycle, but they're going to play it by ear. So they're going to keep their ears close to the ground, get the inflation impulse, get the growth impulse, see what the Fed is doing, and go ahead and accordingly chart. And a good example in this front would be Indonesia. If we had expected the Indonesian BI to cut rates this quarter, but the October meeting is a bit tricky because the rupiah has really moved a lot, again, like you rightly mentioned, in the past week or so. So they might prefer to be cautious and keep rates on hold. But that won't take them off course. I think it will just make them a lot more cautious and do a meeting-by-meeting approach.
Right. So just like I was saying that we have these set of calls which take Fed funds rate down to 3%, but we don't have very high conviction in that call, might be the same page work for many countries in this part of the world.
Certainly, and if we are expecting anywhere between 100 to 175 basis points cuts. So if we compare that to our Fed call, for instance, it's half for some of the countries. So we aren't going full tilt aggressive. They would like to prefer to keep policy differentials. They are keen to attract flows. So yes, this is again not cast in stone. If the Fed finds itself in a place where they don't want to cut as much, the Asian central banks would also be okay with a 25 or 50 basis point less.
So Radhika, in my presentation, I talked about the fact that the PMIs in the region, rather surprisingly, have turned south. It was supposed to be a nice year for us. It was supposed to be a year of steady exports growth. Exports numbers are okay so far, but PMI is saying some bad things are around the corner. Building on that, what's your growth outlook for the remainder of the year? Are we going to end 2024 on a pretty strong note?
Yes, certainly. And I think in PMIs, you've also seen a bit of a divergence. In manufacturing, PMIs have been turning south.
Whereas services have been doing
pretty well. And also this recovery in trade, I think we should also be quite clear that it's not so much a secular rise in improvement in exports. It has certain pockets doing much, much better than the rest. And that's why you can see between countries, their export performance looks a bit different. Going back to your question, certainly we are given our ASEAN 6 outlook, and we've just recently, Singapore economist has upgraded Singapore's outlook as well. So overall, we are looking for a good 4.7, 4.8% growth on average for the region. So we're planning to stick with that.
Very good. Thank you, Radhika. I'll spend the next few minutes answering a couple of more questions, but thanks for your contribution to today's live stream.
Thank you very much.
All right, so blunt and challenging question for me. How confident are you with the Fed call? Well, not very confident. I don't think the Fed itself is very confident. When you look at the economic forecast, when you look at the minutes of the Fed around the last two policy meetings, it's not like all the membership of the Fed is speaking with one voice. Quite a few Fed members wanted just a 25 basis points cut last month, but they went ahead with 50. I think if one looks at the totality of the communication of Fed officials in the last couple of weeks, again, that doubt is creeping in. The economy is doing well. Why do we need to cut a lot? Inflation has come down, but has it come down so much that we can declare victory? Probably not. What do those soul-searching questions indicate? It indicates that the Fed itself is not particularly confident with its guidance that it can actually go ahead and cut rates steadily meeting after meeting, going all the way into the middle of next year. And market expectations have also gone through a great deal of convulsion, precisely because nobody's confident about the outlook. The US economy has turned out to be much more resilient than we had thought. US jobs market, despite giving some signals of softening, is still very, very strong. And US inflation, which has come down substantially, no question about it. This is why we're discussing rate cuts and nothing else. But the only question that remains is the extent of rate cuts. Again, to reiterate, our call for the near term is a confident one. November, December, 25 basis points rate cut each. And we're glad that the market expectations have come back to our view. For 2025, first and second quarter, where we think that another 100 basis points of rate cut is coming, we shall see. I'm not going to be very confident about that. And the final 50 basis points in rate cut, which is for the third quarter of 2025, I am definitely not confident at all about that. Lots going to happen between now and then with respect to the labor markets, with respect to inflation, what's happening to commodity prices. China could itself play a big factor in that. If China's demand recovers in a meaningful manner, global commodities might steady or even go up, and that could create additional complication for the inflation picture. If US financial markets keep on doing well on the back of ample liquidity, we may see housing prices, stock prices all go up to record highs, spill over into consumer prices, again make the Fed's outlook complicated. Well, that's one spectrum of the perspective. What about the other spectrum where labor market does slow substantially and inflation becomes an afterthought or no thought whatsoever, focus goes straight into the labor market? Then the Fed will have to cut quite a bit. I am tilting toward the former than the latter. Time will tell whether that skew in the perspective pans out or not. Okay, so let's clean that out and go to the last question of the day related to the US dollar. It's been choppy. I suppose it's another word for volatile. Do you expect further weakness or strength in the US dollar heading into the elections? Well, that's basically a question for the next 2 weeks, right? I think that the market has shifted just a tiny bit toward Donald Trump's election. And that, in my view, would be a function or would be ultimate result would be a strengthening of the US dollar. Because the policy uncertainty, the global choppiness that would accompany Donald Trump as a president would make investors more risk averse, and that would create an EM-DM rotation, that would create people wanting to sort of seek refuge of the US dollar to some extent, and that strengthens the US currency. And mind you also, if Donald Trump's election probability keeps rising, then the market would start assigning inevitability of substantial additional tariff on US imports, which by extension then would mean the exporters would have to have a weaker currency to offset for that, and that again means a dollar strengthening and weakening of the rest of the world narrative. If the developments over the next 2 weeks is about a neutral 50-50 outcome, the market will sort of trade sideways as well. But a Harris presidency, in my view, would be accompanied by weakness of the dollar, normalization of the narrative, which is the US will cut rates, no further change in the external environment, and around that, EM effects can strengthen, the dollar can weaken, and it all works out on a steady inflation, steady growth perspective. So no question, Donald Trump, more volatility, more risk aversion, Kamala Harris, status quo ante, not that much drama. Well, with that, by the time we come back for the next live stream, all these questions hopefully will be settled, especially in the US election one. Hopefully we will not have undecided, uncertain outcomes, that by then we will know who's the president and can talk about this issue in more concrete details. But until then, everybody stay safe, stay healthy. Thank you very much for joining us for our October live stream. We'll see you next month. Bye-bye.